Welcome back to Options Guide, where we focus on practical strategies that generate real income in real markets. I'm your host, and if you're building an income-generating portfolio with options, understanding this comparison is essential. Covered calls and cash-secured puts can both be profitable, but using the wrong one at the wrong time can cost you thousands in missed gains or unnecessary risk. So let's break down how each works, when to use them, and how to align them with your portfolio goals. Covered calls explained. Let's start with covered calls, probably the most popular income strategy among retail investors. A covered call involves two parts. You own 100 shares of a stock. You sell a call option against those shares. Say you own 100 shares of Johnson & Johnson at $160. You sell a call with a $165 strike that expires in 30 days for $2.50. That's $250 in premium collected up front. Three possible outcomes. J&J stays below $165. The call expires worthless. You keep your shares and the $250. Rinse and repeat. J&J hits exactly $165. You keep the premium and might get assigned, depending on whether the buyer exercises. J&J rises above $165, say to $170. You're forced to sell your shares at $165. You gain $5 per share in stock appreciation, plus the $250 premium. But you miss out on additional upside above $165. That $250 on a $16,000 position is a 1.56% return in 30 days, or about 18.7% annualized, not including dividends. Best conditions for covered calls. Neutral to slightly bullish markets. You own stocks you're okay selling at a profit. Elevated implied volatility, higher call premiums. You want consistent monthly income from existing positions. Cash-secured puts explained. Now let's look at cash-secured puts, the mirror image of covered calls. Instead of buying stock now, you get paid to wait for a better entry point by selling a put option and holding enough cash to buy the stock if assigned. J&J is at $160. You'd love to own it at $155, so you sell a $155 put for $2, collecting $200. Meanwhile, you set aside $15,500 in cash. Outcomes. J&J stays above $155. The put expires worthless. You keep the $200 and can sell another put. J&J hits $155. You might get assigned and buy at $155 but still keep the $200. J&J falls below $155, say to $150. You buy at $155, but your real cost basis is $153 after premium. Instead of buying J&J at $160, you collected $200 and might own it at $153. That's a $700 difference per 100 shares. Best conditions for cash-secured puts. Neutral to slightly bearish markets. You want to own quality stocks at lower prices. You have idle cash earning minimal return. You're buying dips in a systematic way. Synthetic equivalence. Here's what most traders don't realize. Covered calls and cash-secured puts are synthetically equivalent when using the same strike and expiration. For example, covered call is when you own stock and sell a $165 call. Cash-secured put is when you hold cash and sell a $165 put. Both produce similar max profit if the stock finishes above $165. Same max loss if the stock crashes. Roughly equal premium income, adjusted for interest. So which one should you choose? It depends on market conditions and your portfolio setup. Use covered calls if you already own the stock and are okay selling it. Use cash-secured puts if you want to buy stock at a lower price and get paid while waiting. If you're very bullish, skip both. Just buy the stock outright. Tax implications and hidden costs. Now let's talk taxes. Because the IRS treats these strategies differently. Covered calls. If your shares are called away, you're selling stock, triggering a capital gain. If you held the shares over a year, that's a long-term gain. But if the call is short-term or in the money, It might convert your long-term gain into short-term, which is taxed at a higher rate. To avoid this, use qualified covered calls, typically 30-plus days out, not deep in the money. Cash-secured puts. Selling puts doesn't create a taxable event unless you're assigned. Premium collected reduces your cost basis. That means when you do sell, more of your profit may qualify as a long-term capital gain. Hidden cost, dividends. With covered calls, you collect dividends while owning the stock. With puts, you don't own the stock yet, so you miss dividends during the wait. Market condition decision framework. Here's a simple framework to decide which strategy to use based on market conditions. Choose covered calls. When you're neutral to slightly bullish, you already own shares you're willing to sell. Implied volatility is high, boosts premium. You want to boost yield on long-term positions. Example, it's late 2024. Markets are choppy from election uncertainty. You own Apple at $180 and are okay selling at $190. Selling the $190 call for $4 earns you income while you wait. Choose cash-secured puts. When you're neutral to slightly bearish, you're sitting on cash and want to buy stocks at a discount. Volatility is elevated, increasing put premiums. Market just rallied and you're waiting for a pullback. Example, early 2025, markets feel overbought. Instead of chasing Microsoft at $350, you sell the $330 put for $6, getting paid to wait. Avoid both when you're very bullish, just buy the stock. You're very bearish, stay in cash or buy puts. Volatility is extremely low. Premiums aren't worth the risk. Real-world performance. Let's see how these strategies performed in real market scenarios. Bull market, 2023 AI rally. Covered calls on Nvidia limited upside. Shares got called away at $250 while Nvidia ran to $400. Cash-secured puts at $180 expired worthless month after month. Income without ever owning the stock. Winner, cash-secured puts. Bear market, 2022 S&P decline. Covered calls softened losses slightly but didn't prevent downside. Cash-secured puts eventually got assigned at lower prices, setting you up for future gains. Edge, slightly to cash-secured puts. Sideways market, 2015, 2016. Covered calls generated steady income. Cash-secured puts collected premium without assignment. Winner, tie, both performed well. Key takeaways. Covered calls is best with owned stock in flat or gently rising markets. Cash-secured puts is best when buying dips in slow or falling markets. Both struggle in fast-moving, one-directional markets. It's not about which strategy is better, it's about using the right tool at the right time. The smartest traders use both strategies, rotating between them based on the market and their portfolio. If this video helped you decide between covered calls and puts, smash that like button and subscribe for more income-focused options content. Drop a comment. Which do you prefer and why?